In today's video, we'll be going over some stocks that I'll be buying for September. And there's always this one question that I always ask myself: how do all these different finance YouTubers, how do they keep buying different stocks every single month? I've seen this trend going on for over the past probably 6-7 months now, and every single month there's always a new stock to buy. And for me, I haven't really bought any new stocks in the last maybe 2 months, probably. So yeah, there's always something that's been bugging me, and I don't know. If any of you guys are watching, let me know. So now that's out of the way, welcome back to the channel. Let's jump right into it. My name is Bruce Wang, and if you guys are brand new, I am a dividend investor. I just reached $100,000 on my stock portfolio in the last 2 years. I've also have 2 duplexes that I bought, renovated, and rented out. And now I'm a YouTuber. So the portfolio is sitting at $102,000 with an annual income of $3,123. So this is kind of important because over probably the past 2 weeks, nothing much has changed. All right, my portfolio balance has stayed the same. There was a big dip in the market and everything, but roughly I'm still investing, and the portfolio value will always change a bit. Sometimes it'll go lower, sometimes it'll stay the same, and sometimes it'll go up. But one thing that's always increasing, or I'm trying to increase on a weekly and monthly basis, is the annual income. All right, so right now, in the past 2 weeks, I've increased the annual income by roughly just under $100. And that's because I'm buying dividend stocks. And today we'll be going over 3 different dividend stocks that are high risk and high reward, in my opinion. And if you guys are looking for any resources from this video, links are going to be in the description. If you guys are brand new and haven't signed up for any of the brokerages yet, you guys can get some free stocks with Webull, with Robinhood, and all that. And if you guys want to see my entire portfolio, links are going to be in the description down below. So Exxon Mobil is one of those stocks that has been killing me over the past few months. I haven't been really focusing on it until recently. And in September, this is the month that I'll be buying a decent amount. So this is my Exxon Mobil investment so far. Currently, it's sitting at a 9.17% dividend yield. So this is very high. Is it sustainable? In my opinion, a 9% dividend yield is not sustainable. But according to Exxon Mobil, they are trying to reduce all of their spending, and they're reaffirming their commitment to their dividend. So they're really trying to pay this dividend. And we can see this from past years that they've, paid their dividend streak. They have a dividend growth streak of 37 years, uninterrupted dividend streak of 37 years. I'm 32 years old myself, so this has been going on 5 years older than I am. So this is a very important decision for them to keep paying their dividends. But if market conditions get worse, you have to be really cautious of what will happen. According to Simply Safe Dividends, their safety score is around 55, borderline safe. So I know a lot of you guys are probably questioning this decision that I'm having. And like I said in the beginning of the video, this is a higher risk and higher reward scenario. I could just buy Exxon Mobil, sit on that dividend yield, just keep collecting it every single quarter. And if things change, then I'll change my strategy. But this has worked for me in the past, this buying the dip scenario. And I just wanted to show you some examples of it. So here is a great example of buying the dip, in my opinion. So this is Realty Income. Currently is sitting at $65.20. And I just want to show you guys my position and how this strategy works. All right. So I owned 100 shares. Average cost for me is $56.14. Currently, the price of Exxon Mobil is $65. So that's roughly a $9 profit for every single share that I own currently. And total returns for me, 16%, $906. That is a pretty decent gain on a investment of just $6,500. So now let's jump into some of the history here. The last time I bought a share was a few months ago. I've been collecting dividends ever since. So this is one of the strategies and one of the benefits of having dividend stocks in your portfolio. You get paid to hold these companies. If the price goes up, the price stays the same, or if the price goes down, you will still get paid your dividends if they did not cut them or, pause them. So the last time I bought a share of Realty Income was about 4 months ago, May 8th, 2020. I bought 10 shares at $55.34. That lowered my average cost by by a little bit, not that much, because my average cost right now is still $56, but it did lower it a bit. So buying the dips here, that's the first part of the strategy. And the second part is knowing how to value a stock. According to Morningstar, the fair value for Realty Income is $65. And lo and behold, Realty Income has reached the target value of $65.20. So now I'm not trying to buy any more stocks of Realty Income. I'm looking at other companies that are undervalued, and I'll be purchasing more of those companies. Will the price of Realty Income continue to go up? Maybe. Will it stay the same? Maybe. I'm not sure. I can't predict the future, but I'm willing to hold it at this price and collect the dividends. And let's jump into Exxon Mobil really quickly. So Exxon Mobil obviously hasn't been performing well, and according to the media, this company's going to go bankrupt, according to the media, right? So that's some signs that help me make my decision on buying, because when it comes to the end of the world and the end of a company, that's when I decide, hey, man, maybe there's something in this company that won't completely go bankrupt, right? So according to Morningstar's report here, the fair value for Exxon Mobil, this is just one tool that I use, all right? Fair value for Morningstar is at $74. Other tools that I use say the fair value for Exxon Mobil is around, $45-ish. So use different tools. I have links in the description for all these different companies that I'm using, and make the best decision for yourself. So for me, I bought about 5 shares this week of Exxon Mobil, and I bought 5 shares last week. Currently, I want to get up to around 200 shares of Exxon Mobil, and I'm sitting at 125 right now. So my average cost is still pretty high, $47. That's a $10 discrepancy between the market price and my average cost. So I could, maybe bring down my average cost by maybe almost $4 or $5 when I reach that 200 shares. And I'll be collecting the dividends until something changes. And if something changes, I'll let you guys know. So the second stock that I'll be buying this month for September of 2020 is going to be Walgreens Boots Alliance. Dividend yield is sitting at $5.28. Dividend safety is relatively safe. This is a pretty high. This is a pretty decent score compared to Exxon Mobil, 79 dividend safety. So I'm not worried too much about their dividend. I'm pretty sure they'll be able to pay for it. If it goes lower, then that's when I'll start to get more worried, when it's like borderline safe. Dividend growth last year, 8%. That is pretty fast. Currently, this is my position. I own less than $1,000 worth. This is like less than 1% of my portfolio. That's why I leave this second for you guys to see. I'm down currently 16%. So again, I'm trying to lower my cost basis on this and try to get it as low as possible so I could have less losses when the stock does come back around. Annual income is sitting at $46, and current yield on cost is 4.42%. So I do have a long way to go to lower this cost basis on this. And again, when it comes to their dividend growth here, you can see dividend growth streak is 44 years. Uninterrupted dividend streak is at 44 plus years. So this is a lot older than me, and a lot higher dividend growth streak than Exxon Mobil. So again, this is another important aspect of Walgreens and how their relationship with their shareholders are. They're really committed to their dividend. So let's take a look at my investments in Walgreens. I own all of my Walgreens in my M1 Finance portfolio, sitting at just under $31,000. And if we take a look at my activities and we take a look at my morning trading window, I invest roughly about $500 into my M1 Finance portfolio every single week. And this week, I bought roughly $40 worth of Walgreens. That comes about to 1 share. So this is what I'm typically doing. I'm continually trying to lower my average cost into Walgreens, and M1 Finance helped me do that every single week. So with my investment into Walgreens, I own about 25 shares. Average cost is at $42, and so I'm seeing a loss of about 16%. This is a pretty big loss, and it's a lot easier for me to handle this loss because it's such a small position in my portfolio. And I can easily, invest a lot more into this, and this is something that I'll be doing this month. And you'll be seeing that if you, follow my membership group, or if you just want to continue watching my channel, you'll see exactly how this goes and how this plays out. So when it comes to the tools that I'm using for Walgreens, they are saying Walgreens is roughly fair value at $48. So there's a lot of wiggle room there for Walgreens to get back to its fair value there from $35 today to $48 at fair value. Some other sites that I'm using are saying their fair value is around roughly $42 so that's the lower end. And on the higher end is obviously going to be $48. So that's just my target range, and that's something that I'm looking for when it comes to Walgreens. So now for the third stock in my portfolio that I'll be buying for September, we got Intel. Intel is one of the companies that has been doing very poorly for me over the last 2 months. So you can see there's a big trend here when it comes to what I'm buying for September. Basically, I'm buying all of the companies that have been performing poorly over the last 2 weeks to a month. And definitely Intel was one of them. The tech sector was on fire over the past 2 months. And again, Intel was one of the companies that did not benefit from that. And I've owned Intel for about over a year now. And I'm still going to continue to buy Intel. And, I'll talk a little bit later about Apple and Tesla after. But basically, let's jump into Intel and give you guys the lowdown. Dividend yield, 2.66%. That's a really safe dividend safety score here. 5% growth over the last year. Very, very good. And we can see we have a 10% loss, about $100 loss. It's not too bad, but definitely I want to cut that loss percentage down as much as possible. And definitely lower my average cost as much as possible as well. So let's take a look at the dividend information here. Dividend growth streak, 6 years. Uninterrupted dividend streak of 22 years without a reduction. So you guys might be seeing a trend by now. All the companies that I'm invested in, or most of them, they pay a dividend and they are really invested into paying their dividends for their shareholders. There are companies that are growth stocks that I own that don't pay a dividend, but majority of the companies that I do own are paying a dividend. So let's jump into Intel and what's been going on with my Intel investment. So I've been invested in Intel, since May 17th, 2019. So this is well over a year. When I first started investing, I wasn't putting in that much money, but now since Intel has been going down, we can see that I'm invested. The last time I bought was yesterday, almost $50 was just one share. So my average cost is pretty high, and let's see. When it comes to my Intel position, I own about 8.2 shares. Average cost is sitting at $55. The current price is $49. And when it comes to the target price here, so I'll be taking the target price again from Morningstar. We have a $70 fair value when it comes to the target price personally for me. And when it comes to other companies that I'm looking at, their target price is roughly around $57. So this is on the lower and more conservative range. And when it comes to Morningstar, it's sitting at around 70. So that's, in my opinion, the higher range. So those are the three companies that I'm looking at and their targets. And let's say, for example, you bought at all-time highs for Tesla and for Apple. What should you do? So in my opinion, if you're watching this and you're brand new to investing in the stock market, you have to ask yourself, why do you buy the stocks that you buy? Are you buying them because someone on the internet is telling you to buy them? Or are you buying them because you believe in the future it's going to be worth a lot more? If your answer is the first one, then definitely your investment strategy is pointed in the wrong direction. But if your answer is the second one, then definitely your investment strategy is going towards the right direction. So if you believe Tesla and Apple will be worth more in the future, or if they're fair value now and you want to get into them early and you bought at all-time highs, it might be potentially a good idea to lower your cost basis. This is like one of the key strategies when it comes to my investments, is to lower your cost basis on any of the stocks that you own. You can do that through obviously buying low and selling high, or you can do that from investing into the dips, buying the dips. There's many ways you can go about it. Another way is doing some selling option contracts, but I'll leave that for another video. Doing those three things will help you lower the cost basis for your investments, and just look into them. All right. I'm not telling you to do it. I'm telling you, just look into it. Potentially, it might be a good idea. And if you guys want to watch more videos from me, go check out these videos here. Don't forget to like, subscribe, hit that notification, follow me on my other socials, my other channel, my Instagram, if you guys want to, connect with me even more. So I'll check you guys out later. Thanks for watching. Bye.